Hey guys, Craig Steele, Veritas Funding. Hey, I wanted to go through a loan program today that I think is pretty amazing. It's been around for some time, since 2005. Some folks have heard of it called a different name. The bottom line, it's been around. It's a fantastic loan. It's called the All-in-One. First, I want to talk a little bit about a 30-year fixed rate mortgage. 30-year fixed rate mortgages are an awesome loan. I mean, they've been around for 86 years. They've never changed. They were instituted back in the Great Depression. They were designed, truthfully, to help people get into homes. Prior to that, you didn't really have 30-year fixed rate mortgages. And by the way, worldwide, typically there isn't such a thing as a 30-year fixed rate mortgage out there. They're typically adjustable rate mortgages that need to be refinanced every 5 to 7 years. So the American mortgage-backed security system is probably the best in the world. And anybody out there that's watching maybe out of the United States, I'm sorry about that. I just feel that is the case. 30-year fixed rate mortgages. Let's talk about those. There is a fixed amount of interest that you pay on a 30-year fixed rate mortgage for 30 years. Typically, a 30-year fixed rate mortgage has a tipping point, meaning the interest that you pay over a 30-year fixed rate mortgage, it's front-loaded. Most of the interest you're going to pay on this loan is typically in the first third to half of the mortgage, depending on the interest rate. And that is independent of the mortgage rate. It doesn't really matter. Case in point, a 3% interest, you'll pay 150% of the value of a house. A 4% rate, about 178% of the value of the house. A 5% rate, you're almost paying 200% of the value of the house. In other words, twice what the house is worth on this type of a loan. The term 30-year fixed is great. Definitely keeps me in business because that's what I do on a daily basis. But you're paying most of the interest up front, and there is a tipping point somewhere in the 12th, 15th year of where all of a sudden you're paying more interest than you are more principal than you are interest on a 30-year fixed rate mortgage. Which of course then you're going to see an acceleration of principal against the actual balance of your home, and in 30 years obviously it's paid off. The fallacy with that is most Americans either refinance or purchase a new house every 4 to 7 years. If every 4 to 7 years we're refinancing a loan that doesn't actually get to a tipping point of interest versus principal until the 12th or 15th year, we're always staying in that highest percent of interest being paid on a mortgage, no matter what the interest rate is. You're always paying a higher amount of interest than you are principal for that first third to one half of the loan. What I'd like to introduce you to is a loan called the All-in-One loan. What it is a first lien HELOC. Yes, it is an adjustable rate loan, but it's exactly what it sounds like. It's a home equity line of credit in first lien position. What this does is it gives you a tremendous amount of power because it is giving you a line of credit based on when you close at consumption of your loan, and your line of credit is basically an 80% loan to value on a primary residence, maybe 75% on a second home or a investment property. But that line of credit is established and stays for 360 months or 30 years. Why is this a cool option? Well, the thing I like about the All-in-One is you can actually front load principal into this loan, and interest is secondary to the principal. What I mean by that is, take for example, if there's two people in a household, man, wife, wife, whatever, it doesn't matter, and they are contributing both to the mortgage. Many times we collect our paychecks and they sit in the bank account in a 0% interest earning checking account or savings or something like that, waiting for the first of the month to pay that payment. And it just sits there, just sits there, just sits there. What if when you got paid or any additional funds that you received, it actually went against your principal balance immediately? So let's just take a case scenario here. Let's say we have a couple that make about $15,000 on a monthly basis. $7,500 from one, $7,500 from another. As the wife, the husband, whoever gets paid like every 2 weeks, and maybe they get paid weekly. Let's just assume it's every 2 weeks, but they're on off weeks. So my wife gets paid first week, I get paid second week, she gets paid third week, I get paid fourth week, and of course there's 52 weeks in the year, so occasionally there are those extra couple of payments or extra couple of paychecks that come out. What if that pay was immediately put against the principal balance of your home, and you had checkbook access, debit card access, a regular banking account tied to your mortgage that as the payments go in, your principal balance reduces, and the interest, therefore, that you're paying over time is greatly reduced. That's why I like this loan so much. Case in point, the average person that has this loan pays off their home in 10.5 years. Now, there could be pros or cons to that. You know, sometimes there's that tax deduction. You don't want to pay off the mortgage because you're deducting interest on your, on your taxes on an annual basis. Well, that's great, and obviously talking to a financial planner or a CPA is the best interest for you with that. But just in my mind thinking, if I have a $400,000 home and I'm putting $15,000 against it on a monthly basis, it doesn't take a rocket science to realize that if I'm at 400,000 now, I put 15 against it, I'm at 385 next month, I put 15,000 against it, I'm at 370 the next month, so on and so forth. You can see how accelerating your principal, still having checkbook access, still having debit card access to do your monthly, groceries, gas, bills, everything, you can see where you can accelerate the interest where you're paying it off much, much quicker than you would on a regular 30-year fixed rate mortgage. And the key to this is a 30-year fixed rate mortgage has front-loaded interest where no matter how much you pay or as you're paying your payments, that money is only going to drop off a specific amount of principal on a monthly basis, and the majority of that's going to be interest for the first several years for the first third of the loan. I really like this program, and the reason being is because people can reach financial freedom and have access to their line of credit to do with what they need to do. Case in point, I had a loan the other day that a client was buying a very large property. We did the calculations. Salesperson makes a substantial amount of money on a monthly basis, and typically that money was just sitting in a savings account or checking account, not earning any money. I introduced this program to him, and he was like, wow. This program is pretty awesome because my money's working for me instead of just sitting in a bank. And also my line of credit, based on the first lien HELOC, is established. I am really not losing anything. That amount of money is still there for me to draw out on at any time in case I needed something. The nice thing about it as well is the loan's kind of recession proof. And I shouldn't say recession proof, it's recession resistant, because if someone loses a job and they exceed their line of credit, well, that could be a bad thing. But if, for example, you're a salesperson and you are used to a large chunk of money coming in from commissions or sales or whatnot, and there was a month or two, kind of like COVID, when things kind of stopped a little bit, where maybe you weren't receiving that amount, but you were still receiving your base amount of income, just not your commissions or your bonuses. Well, because this loan is such a cool loan, interest is calculated on a daily basis based on your balance. So if on a regular time you're putting that money against the loan, the $15,000 that we were talking about previously, and it's reducing your principal, what if all of a sudden you were just getting your base amount of money that you needed to utilize for your bills and expenses, but there wasn't any extra cash until supply shipped or something of that nature? I call it recession resistant because the minimum amount of interest on the loan and withdrawn out of that home equity line of credit on the 21st of the month. So truly, it's recession proof. If you had a 30-year fixed rate mortgage and all of a sudden you were laid off, or you weren't making the money you were before, there's a certain amount of time before the bank comes knocking and saying, hey, you're getting behind on your payments, we're going to foreclose. Well, not the case with this loan, because you have your line of credit and you have the ability to float, if necessary, for a substantial amount of time. So that's why I call it a recession-proof mortgage or recession-resistant mortgage. It is tied to an adjustable rate. It's the CMT, which is the constant maturity treasury, which is the average of treasury notes, the 2, the 7, the 5, the 10. It's the average of the two put together. So many times when I do this analysis, people say, well, I've got a 2.75 interest rate, or I've got a 3.5% interest rate. I definitely don't want to do anything with that. I don't care what your interest rate is. I can demonstrate with a simulator based on your current scenario versus a all-in-one first lien HELOC, where your first lien HELOC is going to outperform your typical 30-year fixed rate mortgage. And the only reason being is because you're front-loading that principal and it's reducing your amounts substantially monthly instead of just sitting and playing the wait and see game. Very interesting program. It's definitely something that I'm excited about. It's not for everybody, for sure. If it's, if you're somebody who all of a sudden gets a line of credit and it's maxed out day one, it's probably not the right program for you. This is for people who are cash positive at the end of the month and have money sitting around, and something that would help them create leverage or equity over time, and a substantial amount of that. The nicest thing about that as well is this line of credit goes, as the line of credit is established and you're paying that mortgage down, let's say kid needed to go to college, or let's say you needed to buy a new vehicle. Well, you can actually tap into this line of credit, buy the vehicle for cash, and yes, it is amortized on your payments, but case in point, let's say it's a $50,000 car and you're paying $15,000 a month against the mortgage. That car's paid off in 3 or 4 months versus 84 months at 6.99% interest, which is not tax deductible, and this is. So there's a lot of benefits to this program. I would encourage you, if you have interest in something like this or want to learn more, you reach out to me. My name is Craig Steele. I'm the regional manager for Veritas Funding. 801-641-8788 is my phone number. I look forward to talking to you and actually helping you understand more about this program. Talk to you soon.